Billionaire investor Warren Buffett is warning about a major storm that is about to strike the U.S. real estate market. This $1.4 trillion debt-fueled tsunami has already started to hit the real estate market as we speak. However, this is just the beginning of the, quote, consequences Buffett sees of this real estate bubble.
In today's fragile market and uncertain global climate, Warren Buffett's recent words have stirred fear among individuals. A worse crash than 2008. His words cast a dark cloud over the financial world's future, sparking intense speculation among investors and analysts. Memories of the 2008 economic disaster come up again, increasing concerns about what's to come. Given Buffett's seasoned insight and successful history, his alarming message encourages swift action and causes many to brace themselves for what might lie ahead. In this video, we'll look at how the 2008 crash compares to 2023, and will it get worse? A worse crash than 2008? The housing market is an important aspect of the economy, as it not only provides shelter for individuals, but also serves as a major source of wealth accumulation for many. However, it can be unstable and risky. When housing prices go up too fast, it can cause big problems. These problems, called bubbles, can cause damage to homeowners and investors. The 2008 financial crisis showed us how risky it can be when the housing market gets too hot. It grew quickly because it was easy for people to borrow money, and banks weren't strict about who they lent to. But then many of the people who borrowed money couldn't pay it back. This caused big problems for the banks and the economy, leading to a bad time we call the Great Recession. The 2008 crisis affected a lot of things. Many homeowners lost their money, and lots of houses were taken back by banks. People felt unsure about spending money too. The crisis also affected big banks, and some of them almost went out of business. This bad situation didn't just impact the United States, but also had a big effect on the whole world. It caused problems in different parts of the economy and different countries. And now, Warren Buffett, a famous investor, is warning about a potential crash worse than the 2008 crisis. This warning is drawing more attention to the Buffett indicator, which has now predicted 3 market crashes in a row, making it a key focus for many people today. History often repeats itself, and the current situation in the housing market seems to be following a similar pattern. In fact, a recent analysis by Goldman Sachs suggests that the current state of the housing market is even worse than the crash of 2008 in some aspects. This shows the urgency of being cautious and attentive to the evolving financial situation, especially in the housing sector. Right now, mortgage rates are higher than they've been in over 20 years, reaching about 7.5%. At the same time, home prices are steadily going up because there haven't been enough houses built over the past few decades. In the second quarter of 2023, the Census Bureau found that the average price for a house in the U.S. was almost $500,000, which is almost double what it was when the housing bubble burst back in 2008.
Stocks sell at silly prices from time to time. It doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act.
That there, as I'm sure you are all aware, is Mr. Warren Buffett, the 92-year-old oracle of Omaha. He is the CEO of Berkshire Hathaway, one of the largest companies in the world. And the reason most people know his name is because he is the world's best investor.
Comparing the housing crash that caused the Great Recession 16 years ago to now, most things seem to be in a better place, except for one major problem. It's getting harder for people to afford homes. Even though the housing market and other important consumer aspects are much more stable now, it's become even harder for new buyers to afford homes compared to the peak in 2006 before the crash. Unless something negative happens in the broader economy, like too many houses being available for sale or a rise in unemployment, experts expect home prices to keep going up slowly. The concerns about housing costs are not just from one source. The Atlanta Fed's Home Ownership Affordability Monitor, which looks at various factors such as median home prices, median income, mortgage rates, monthly payments, and the percentage of income spent on mortgages, shows that housing affordability has worsened beyond the levels seen in 2006. In July of 2023, housing affordability had fallen almost 8 percentage points compared to the previous year, remaining more than 31 percentage points below the level considered widely manageable. It's anticipated that by the end of this year, home prices will go up by 1.8%. Looking ahead to the end of 2024, the prediction is even higher, with a projected increase of 3.5%. Challenges facing the housing market today. Today's issues in the housing market are quite different from what we've seen before. For instance, about 20 years ago, the availability of products like zero down payment mortgages and cashing out home equity assisted more Americans in buying homes, which drove up real estate prices during the last crisis. However, today's high prices are primarily due to a scarcity of available homes for sale. In fact, the inventory of houses for sale is currently at historic lows, having dropped an astonishing 60% to below 700,000 active listings between September 2018 and September 2023. Right now, there aren't many homes available for sale, which might explain why home prices are staying strong, even though it's hard for many people to afford them. But from 2004 to 2009, more homes were being built, while the prices were not going up so quickly. There were also lots of homes that people couldn't pay for, which made things even harder. Today, both mortgage rates and home prices are going up at the same time, which is tough for people who want to buy a home but can't because it's too expensive. In the last housing crisis, when people had to pay more for their loans, home prices went down. But that's not happening now. Unlike before, home prices these days are going up along with mortgage rates, mostly because there aren't many homes for sale. These issues are making both buyers and sellers wait for things to get better before they make decisions about buying or selling homes. It doesn't seem like there will be better deals for people wanting to buy homes anytime soon, unless there are more homes available, more people lose their jobs, or mortgage rates go down. Goldman Sachs still believes that home prices will keep going up until next year. With interest rates now much higher, it's even harder for new home buyers to afford houses compared to the period from 2004 to 2007. Experts expect that home prices will keep rising slowly in the next few years. The commercial real estate sector. The commercial real estate sector, already facing challenges due to the shift to remote or hybrid work, needs to refinance more than half of its mortgage debt in the next 2 years. Analysts are predicting that the decline in commercial real estate could be as much as 40% worse than during the Great Financial Crisis. Concerns about this sector being the next one to face problems have grown, especially after recent bank troubles. The fear is that increasing interest rates will continue to harm various markets. Commercial real estate has already suffered a lot because of the COVID-19 pandemic. In 2020, many offices shut down to stop the virus from spreading. Even after things started reopening, not everyone returned to work in person, leaving many buildings empty. Office vacancy rates have gone up a lot, with more people working from home. The sector has seen a permanent change in how many people use office spaces. Because the government wants to control prices going up too much, they've made it more expensive for people to borrow money, hoping it will slow down how much things cost. The Federal Reserve has increased the cost of borrowing by a lot, the biggest increase since the 1980s. Interest rates have gone from almost zero to over 4.75% in the past year. When Silicon Valley Bank failed in March and caused a lot of problems in the economy, it made things even harder for the commercial real estate market. Banks are now more careful about giving out loans because they worry that if lots of people take their money out of the bank at the same time, they won't be able to pay back the loans they've given. banks that have given out a lot of loans for commercial buildings are going to face some tough times ahead. The debt in the commercial real estate sector is a big problem. More than $2.4 trillion of debt will need to be paid back in the next 5 years, which is more than ever before. This is a big risk for smaller banks, which have given out 70 to 80% of all the new loans. While it's still possible for the economy to not crash too hard, recent problems with regional banks and the stricter rules for giving out loans are making that change less likely. According to Forbes, the storm is expected to hit either by the end of 2023 or at the start of 2024. They base this prediction on the fact that history has shown that it takes about a year for changes in how money is managed to affect the economy. Others think the recession might come earlier, around the middle of the year. But either way, most people agree that 2023 will bring some serious economic problems. When we hear the word recession, we might think back to 2008, when many homes had signs saying they were being foreclosed, like tombstones, in the neighborhoods that were hit the hardest. However, if there is a downturn in 2023, it will likely happen differently, and surviving it will mean making different plans and getting ready in different ways. Before the Great Recession, banks were giving out loans too easily to people who couldn't afford them, to pay for risky and not so responsible mortgages. There wasn't much supervision over this. This made a housing bubble, and when it burst, it left banks and investors with trillions of dollars in mortgages and mortgage-backed things that were worth nothing. In 2021, high prices in the housing market were caused by inflation, not a bubble. Factors like supply chain issues, low inventory, a lumber shortage, COVID-related shutdowns, low interest rates, and more people working remotely all contributed to this. Yet, some think it won't be like 2008 because the growth we've seen isn't based on risky mortgages given to people who couldn't afford them. They believe the housing market isn't crashing, but correcting. The market is already starting to correct itself, and property values are expected to continue decreasing. Experts predict a slower, more controlled decline, not a sudden crash like in 2008. Investors are betting against real estate stocks, but that's just one way to make money among many strategies. With concerns spreading about a potential market crash more severe than the catastrophic 2008 crisis, Warren Buffett suggests that investors should be careful and smart with their money, spreading it out and being cautious about what they do. Being careful about risks and staying alert in the face of the ever-changing global economy is important. What do you think? Let us know in the comments section below.